Wondering how ETFs can fit into your portfolio? Join us for our Fall into ETF Investing event, premiering October 13th and 20th. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. And don't forget to subscribe to our YouTube channel and hit the alert button so you never miss an episode. Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hello, good afternoon, and happy Friday. I'm Danielle Neziol with BMO ETFs, and this is ETF Market Insights. It's September, and we're all thinking about back to school. So we thought a great idea for our episode content today would be to kind of take a step back. We're calling it a back to basics, and we're going to review RESP accounts, Registered Education Savings Plans. And today with me to help us through this conversation is Kornel Szrejber. Kornel is the host of one of Canada's leading podcasts on finance, Build Wealth Canada. Kornel, it's so good to have you join us today.
Awesome. Thanks for having me back, Danielle.
Thanks, Kornel. Before Kornel and I get started, we do have to remind you today we're not providing you any advice. We're not providing you any recommendations. Today's episode and all our episodes are about empowering the do-it-yourself investor in Canada so you at home can make the right decisions for yourself and your investments and your investment objectives. So today, RESPs, I think this is a great topic for anyone who is dipping their toes into thinking about investing. This kind of account is easy to open up for Canadians. It's available to all Canadians, and it serves a fantastic purpose to fund our children's education. I can't think of a better thing to fund. So just a little bit of a background. If you're unfamiliar with RESPs, it is a registered education savings plan. An RESP really is an account or a savings vehicle to put away funds for our children to save for post-secondary education. And anyone can actually open an RESP. You don't have to be a parent. You can be a grandparent, a relative, or a friend. Everyone is eligible to open up an RESP for a beneficiary, which is a child under the age of 18. And that beneficiary also has to be a resident of Canada and have a social insurance number. But here's one of the great benefits of an RESP. The money within an RESP will grow tax-free, and it won't be subject to tax until the money is withdrawn to pay for the beneficiary's post-secondary education, at which point it will be taxed, but it will be the beneficiary, so that child's tax bracket, which it will be taxed at, and usually 18-year-olds or those going off to school are students and are taxed at the lowest tax bracket, sometimes not even taxed at all. So a lot of great benefits for RESPs. We're going to get into them all a little more with Kornel. So Kornel, you are a pro at managing your own RESPs. You manage RESP accounts for both your children. Can you just walk us through the steps or the process it really takes for a Canadian investor to open up these accounts? Maybe kind of demystify it, because I think there's a few Canadians that just might be intimidated by actually opening an RESP account.
Sure. Yeah. So step number one is really to choose a discount broker. And if you already use a discount broker for your RSP or your TFSA, then it's actually really, really convenient to just use the same discount broker that you're already using, since they already have all your information. And so really the new information that they need has more so to do with your kids because they already have everything for you. So that really, really helps speed up the process if you use the same one that you're already using. Now, if you are completely new to this, or maybe you've had someone else do all your investments before and you're just getting started and you don't have a discount broker account yet, then of course it's smart to shop around and see what kind of things they are offering. Oftentimes, different discount brokers in Canada will run different promotions if you join them, and sometimes it can be even like several $100s potentially, depending how much money you're willing to put in. So definitely worth shopping around and seeing what's out there. If this is something that you're kind of starting from scratch, one thing to keep in mind when you are choosing a discount broker is what commission they charge per trade. So this is the amount that you'll pay every time that you buy and sell, for example. Now, some brokers, they let you buy ETFs commission free, but you have to actually pay the commission when you sell. There's other brokers where you can buy and sell without paying any sort of commissions, but it has to be an ETF from their specific list. And then there's other ones where they will always charge you a certain fee depending on who they are. The amount tends to be between $5 to $10 per trade. So that's something that you do want to factor in. You're not going to be doing a massive amount of trading here, but it can add up over time. And because there's so many good options out there, it is worth considering. Every little bit, every dollar that you save is a dollar you could potentially invest, right? And then that can compound over time. So it is worth to really consider that as well. Now, me personally, I just use the same discount brokerage that I use for my retirement accounts, which, like I said, made setting up the RESP very fast and easy since they already had my information. So that's basically step one, just get that discount brokerage account up and running. And if you already do, just open up the RESP account. But so step two is, once you know which discount brokerage you want to use when it comes to RESPs, you have the option typically of opening either a regular RESP for each of your children, or you can open just one family RESP, and that would be for all of your children. So I personally use the family RESP for my two kids because you're dealing with opening just one account, and the kids are able to share the funds in that account. And this can be really useful because, like, my kids are 5 and 9. I have no clue what they're going to want to study when they're older. So one maybe will want to be like a doctor or a lawyer, in which case the education is going to be pretty expensive. And then maybe the other one will want to do like a much shorter college program, which is obviously going to be a lot less expensive. And obviously none of us can see the future. We don't know what our kids are going to get into. But if that was the scenario, then what's nice about the family RESP is that you can take more of it out for one child and less for the other. So like the doctor lawyer child would obviously get more of it and the other child would get less. And so it does give you that flexibility, which is really, really nice. And if you have more kids in the future, you can add them to that family RESP plan. So it's not like, basically it's kind of a no-brainer to me personally, is to just have the family one because you can always add kids to it. And even if you have just one child, you can still have a family RESP. And then if in the future you decide to have more children, you can just add them to it as well. So that personally that's what I personally do. And from the multiple financial planners that I've interviewed over the years on the Build Wealth Canada podcast, literally all of them suggested using a family RESP. So basically what I use, instead of opening up a separate RESP for each kid. So I would say that's applicable for most people. There are some exceptions, some caveats, like for example, the one that I've heard when in the other financial planners about it was, let's say you're in your second marriage, maybe you had a child in your first marriage, and so you want to keep maybe that child have their own RESP, from the previous marriage, and have the kids in the new marriage be in a family one. So some people like to kind of structure things that way, just to make it sort of separate. But like I said, in the overwhelming majority of cases, and from all the financial planners I've interviewed, the family RESP tends to be, I would say unanimously from everyone I've interviewed, to be the better option in most cases for people, for the advantage. And then once you have that, once you've decided, okay, I want to do, let's say, a family RESP, the next step is to actually open the RESP with your discount brokerage. So to do that, it's fairly simple. You just need to fill out some forms online, and the information that you want to have ready that they're going to ask you is, one, they're going to want your social insurance number. If you want your spouse to contribute as well, they're going to want your spouse's social insurance number as well. So it's good to have that those numbers ready to go, just so you can copy and paste them in. They'll also need the social insurance number of your children and the birth dates of your children as well. So hopefully you have those memorized. If you don't, look it up, because they definitely asked me when I set mine up. Now, some discount brokerages, they will have a minimum funding amount. So for example, with the one that I use, it's $1,000. And that they don't want you to open an account and then put like $1 in there and then forget about it, right? They have like administrative costs, things of that nature. So typically there can be like a minimum funding amount, and then you can put that money into whatever you want, but they just want you to have some money actually in there. And like I said, $1,000 is what my brokerage uses. I imagine that varies from broker to broker. And that's it. But like I said, if you're opening up a brand new discount brokerage account, then they're obviously going to ask you for more information about yourself. Like they're going to want, evidence. They might want your driver's license, other IDs. But that they would require that if you opened up a account anywhere, really. But the RESP specific things are actually quite straightforward. It's mostly just your social insurance numbers, names of your kids, things you already know, their birthdays, and then you're good to go.
Kornel, you did mention the family account option. This is something I also learned while I was in the process of opening up my daughter's RESP. I only have one daughter now, but I did elect to do the family account. It just seemed for me like the most consolidated, easiest idea to manage. Well, right now I'm one daughter, but eventually if I have more children, it just seems easier to have them all within a single account, managing everything under one umbrella. So that made sense to me. Now, Kornel, once the account is opened, what do investors need to know about the funding parameters around an RESP? And then maybe you could touch upon the government grants that go along with that.
Sure. So funding, it is very easy. If you've ever paid a bill online, it's essentially the exact same process. So typically discount brokerages have different ways that you can fund your account, but you would fund it the same way that you might be already funding your TFSA or your RRSP. So the way that I personally do, what I found to be the most convenient is, just through the online banking. So I would log into my bank, and when setting it up for the first time, I would just go to pay bill. So even though you're not really paying a bill, that's kind of the menu that you go into because you're sending money to a different company. And so when you go to pay bill, if you've never done it before, you're going to want to add your discount broker as the place that you're paying. And so you would basically just enter the discount broker that you decided to use. You'll be able to find it there on the list. You can search for it. And then once you progress through that little wizard that's going to come up, the little window, it's going to ask you for the account number. And so that's how they're going to know which account to actually send the money to from your checking account. And so obviously here, you want to make sure you enter the right account number. Your RESP is going to be a different number than your TFSA, and that's going to be different than your TFSA. And so typically when you set these up, like I know with my bank, they even let you do like a label. So I would say like, family RESP, right? And that's how I would label it. And so you have put in your account number from there. And then now you just pay it the same way you were an online bill. So what I like to do is, for example, every year, when I'm going to put in the next amount, I just go pay bill. I select the RESP account there from my pay bills window, select checking account. I wanted to accrue, and then the money is going to get sent right to the discount brokerage. So once it's set up, it's a really, really easy process. I would say no different than if you're paying your utilities or something like that. Very, very straightforward. And then now once you do that, what's really important to know is, well, the money is going to go into the RESP and it's going to show up there as cash. Now, it could take a little bit of time for it to show up there, so don't panic if it doesn't show up like a second later after you've done the transfer. It can take some time for it to show up. But once it does, it's going to be there as cash. And so you need to remember that you still need to actually invest that money. So just because it's an RESP, it's not like it's automatic. It's not like some high interest savings account where it's automatically going to start calculating your interest. You actually have to take that cash and invest it in whatever ETF, for example, you feel is most appropriate for you, which we're going to cover later in this episode. But just definitely remember that, because I would hate for someone to think they're invested and it's just sitting in cash there for like a decade and they missed out on all those capital gains and income. Now, the other thing to remember is that you won't get the grant money from the government immediately. So just keep that in mind. When it does arrive eventually, it shows up as cash. So what I like to do is I like to set a reminder in my calendar to check the account in 3 to 4 weeks to see if the grant money from the government has arrived. And then once it has, you the same way that you invested your RESP cash earlier. So you can see it's kind of a few steps, right? So step one, you put the cash into your RESP, you wait for it to show up, you invest it, and then you wait for the grant money to come in, and then eventually it shows up as cash, and it's just going to appear in your account automatically, assuming you set everything up properly, and then you just invest that the same way. So it's kind of neat because you just kind of see this, $500. Let's say if you have one kid show up and you're like, oh, I just got $500 for free, this is great, and then you buy it, you use that to buy an ETF. So that's essentially the process of how it all goes. Now, in terms of the amount, so what I like to do is I like to aim for $2,500 contribution for each per year. And the reason I do the $2,500 per kid per year is that this way you get the maximum grant, which is $500 per child per year. So the grant itself, it's actually 20% of what you contribute, but the maximum amount that they'll give you per child per year is that $500. So if you put $2,500 in, you're getting the max amount because 20% of $2,500 is $500 per child. Now, you may run into a scenario where, let's say, I don't know, maybe you didn't have enough money to max it out this year or last year, whatever the case may be. So you may wonder, well, what if I can only put in $1,000 this year? Will I get anything? Yes, they're just going to take 20% of that $1,000 that you put in, and that's the grant money that you're going to get, as opposed to getting that full $500 per child per year. So that's just something to keep in mind. So, better to put in $1,000 than nothing at all. I will mention too, what's important is there is the whole area of a catch-up year, I'll call it. So if you missed one or more years, you can do what I'll call catch-up contributions. However, you'll only get the grant for 2 years maximum per child. So I'll explain this with an example, just because it's a bit more of a complicated concept. So let's say, for example, that the easiest scenario is you did not miss any years. Like you set your REA up right away, you didn't miss any years of contribution, you've been maxing out your RESP every year. Then it's very simple. You just put in $2,500 per year to get the maximum grant per year per child. Now, if you did miss some years, then what you would do is you could put in $5,000, and in that scenario, you would get $1,000 of the grant for free from the government. So that's kind of one thing to keep in mind. You don't lose the years that you didn't contribute. You can still contribute. It's just you can't not contribute for 5 years, and then all of a sudden the 1 year you just go nuts and you contribute for all those 5 years. The government doesn't want you doing that, and so that's why they said, okay, look, we'll let you max it out for this year, and then we'll also let you do the max amount for the one of the years that you missed. So you can basically do 2 years if you have these catch-up years. So hopefully, did I explain that okay, Danielle? Was that clear? That's kind of a more complicated concept, I would say.
That made sense. And I'm like, I already need the catch-up year because my daughter was born in June, and I didn't open up the account until I think January because I was a tired mom the first 6 months there. So a good example there, I can use this year as the catch-up year and put in a maximum of 5,000 if I so choose to do.
Exactly. And what you definitely want to do, what I do is to track all of this in your own spreadsheet so that you always remember, okay, what did I put in? Did I end up receiving that grant money? If not, contact your discount brokerage to find out what's going on, because you should have gotten that money. If you've been waiting for a couple months and it still hasn't arrived, then okay, something might be wrong. I had that issue happen on my end. So you do want a spreadsheet to track your contributions, what you got on the grant, and if you did miss some years, you want to remember, you want to have it tracked. Okay, how many sort of missed years do I have, so that if I have enough money, I can use those up going forward, because I can only catch up 1 year kind of extra per year. So definitely the spreadsheet, I would say, is a very, very useful thing. You do want to track it, and if you're not sure, if you're like, oh, this is a hassle, it's like, well, the government's giving you like $7,200 maximum per child. That's a pretty big deal. So it's worth adding a few numbers into a spreadsheet just to make sure you get the maximum amount in there. And then, so like I mentioned, 7,200, that's like a new thing that I just said. So that is the lifetime maximum grant money per child. So again, you do want to track this in a spreadsheet to make sure you're contributing the right amount. So like I said, you can get this $500 every year per child, assuming you're maxing it out, but then the grant amount is going to stop at $7,200. And so that's obviously good to know. So you don't keep contributing and then you're wondering like, hey, why aren't I getting this grant money? It's like, oh, well, you've already maxed it out for this particular child. So again, that's why the spreadsheet can be very, very good. And I will say one final caveat, and that is that if you are more on like the lower income family side of things, you might actually be able to get more than that. So there are a few sort of caveats, few rules in place, like kind of like income check type things that the government could actually, you might be eligible to get more than that depending on your family income. And so there's a few of them. And so if you want to learn more about that, what I recommend is you just Google RESP and then space and type in CRA, or Canada Revenue Agency, the Canada.ca website. You can just go on there, and there they will list all the other things you might be eligible for, or you can even call the CRA and ask them about that. And then that way, because maybe you're eligible for more depending on your situation. So that is essentially the answer in a nutshell, in a long nutshell.
No, it's perfect. Even your point about just making that e-transfer into the account from your, like, I had to learn all those things too. So it's good you're walking us all through that, because these are the little things I think that intimidate investors from really just getting started and getting invested, is just figuring out all these kind of small things that really aren't that hard.
I think so. There's all these like barriers, right? That it's like, okay, I want to do it, let's do it. And then you're like, wait, do I do a family one or an individual one? And so now you're like, okay, now I got to go research this. And then you're like, all right, I finally got one open. Now I need to contribute. Okay, wait, which is the easiest way? How's it going to take? When do I get the grant money? Do I have, is that like, there's all these kind of questions, right? So, which I think can really help with procrastinating because it's like, oh, I'll figure it out later, and you're a busy parent, you know what I mean? And so it's nice to get it all out there.
Yeah, absolutely. I'm guilty of the procrastinating too, and I work in investments and I teach people to do this stuff, and I'm definitely guilty of it. So, but that's why I'm so glad we're doing this episode, just to remind people it actually isn't too hard, and here's all the things you need to know so you feel equipped when you go and actually go to open that account. A couple things I'm gonna just highlight again that Kornel, you mentioned. So that maximum government grant amount is $7,200 per child. If you're able to max that out, wow, that's such a powerful thing to get to add to your child's education. And a reminder that money is growing tax-free until the beneficiary starts making withdrawals, at which point it's probably going to be taxed at a very, very low rate. And then the maximum amount that can be contributed per beneficiary is $50,000. Now, Kornel, you talked us through just figuring out what discount broker people would like to use, opening up that account, transferring the money in. We're now going to kind of get to the investment side of the equation, because you had said, remember, don't just leave it in cash. Once the money's in that RESP, you want it to grow and you want it to work for you. So as an investor, and if this is your first time investing, you have to sit down and you have to ask yourself a couple questions about what you want that investment to do. What's your goal for that account? This one, it's very easy to determine. Our goal for this account is saving for our children's education. So that's easy to understand. If you are opening these accounts, if your children are really young or infants, you have what we call as a long time horizon. So probably around approximately 18 years, you have to invest and grow and contribute to this account. Your objective, I guess, is your goal, which we kind of outlined, is saving for that post-secondary education. And then you kind of want to reflect on what is your risk profile. So as an investor, are you comfortable with the market moving up and down? Are you comfortable investing in equities, understanding that there can be more volatility in the short term, but there can be more growth potential in the long term? Or are you someone who can't stomach volatility and wants stable investment? You might be willing to sacrifice a bit of growth for that to get that stability, looking at something like bonds. These are questions you have to ask yourself. Typically, when we look at a long time horizon, so we're looking at something like 18 or 19 years, there can be room for taking on a little more risk, because we have time for the market to kind of move up and down. We know over long periods of time, the market does go up, but in short-term windows, markets can go down. So those are just kind of some things to think about as you start thinking about putting money into an investment. So Kornel, so we've opened the account, we've funded it, we've determined our objective, our time horizon, our risk profile. Now, how does an investor decide what to invest in? Because this can also be a very intimidating subject.
For sure. I'm a big fan of ETFs, but even with that alone, there's still thousands out there of them available out there. So that's still intimidating when you're dealing with over 1,000 potential decisions. So for me personally, asset allocation ETFs are the perfect fit for our family RESP, and that's literally all that I invest in now within the RESP. And a few reasons for this. So one, they are very low cost. So for example, I buy ZEQT, which is, and like I said, that's literally all that I buy now for my RESP. That has an MER, which is the management expense ratio, in other words, the fee. It's 0.2%. So that means for every $10,000 invested within the RESP, I'm only paying $20 a year. So if you go out there and you shop around and you look around, you'll quickly learn that 0.2% is an extremely low fee, and you're definitely getting a very good deal when it comes to things on a cost basis, when it comes to the fees for your funds. So that's one key reason. The other big reason I like the asset allocation ETFs is that it's very convenient. So by going with an asset allocation ETF like this, your entire RESP portfolio can consist of just that one ETF. And even though it's just, you look at it and you're like, oh, well, it's just one investment, but you actually still get excellent diversification, since a single asset allocation ETF, like ZEQT, for example, the one that I get, it actually holds thousands of companies across the world. And so you're still getting very good geographic diversification, and you're getting very good diversification by industry, which is all very, very important. And if you're holding an asset allocation ETF that has bonds, so like I said, I do ZEQT because I would consider myself like a high risk sort of profile investor, like good risk tolerant type of investor. So I'm going to ZEQT, which is 100% equities. But for a lot of people, they want to have some bonds in there. They don't want their portfolio to fluctuate as much. And so if you pick something that's a little bit more conservative, that typically means that you're picking an asset allocation ETF that actually has some bond in it. And in that case, like in the case of something like ZBAL, for example, even ZGROW, you're holding over 1,000 bonds. So you're still getting all the diversification that you would ever want, both from the bond side and from the equity side. So really, really convenient, instead of you trying to think, okay, what should I get for my US equities? What should I get for my Canadian equities? What should I get for bonds? All these decisions. Here, it's basically all done for you in a single ETF. Reason number three is that it's really, really easy. So the great thing about the asset allocation ETFs, and what I love using them for my own RESP, is that they do automatic rebalancing. Now, in case you're new to all of this, rebalancing basically helps ensure that you are buying low and selling high, that you aren't holding too much of any one particular investment if, let's say, there's been a significant increase or a drop in price. So that is really, really important. And if you go on your own and your research, you'll quickly learn that rebalancing your portfolio is like a critical best practice when it comes to being a DIY investor, and asset allocation ETFs do that for you automatically. So really, really good from that angle. And what's nice is that you don't need a spreadsheet or to do any sort of data entry to rebalance. Whereas if you're buying individual ETFs, so like non-asset allocation ETFs, then you have to be responsible for rebalancing yourself. So now you actually need a spreadsheet, you need to do some math, you need to figure all that out. With asset allocation ETFs, it does all of that for you automatically. You don't even see it. So it's really kind of nice peace of mind knowing that you are nicely diversified and that you're not holding, let's say, too much of Canada or too much of US because the market shifted, let's say. And I will mention too that literally every financial planner that I've ever interviewed on the Build Wealth Canada podcast about RESPs, they also said that your RESP account should be viewed as its own portfolio, separate from your retirement accounts. Because after all, this is for your kids' education. It's not for your retirement, right? So that's two separate things. And so because of that, when you think about it, asset allocation ETFs, they make a lot of sense, because an asset allocation ETF like the ZEQT I mentioned, or the ZGROW, let's say, they are their own diversified portfolio, all in a single ETF. So why this is so nice is that you just have to choose one asset allocation ETF and you're basically done. Then you just keep buying that one ETF every time that you have new money to invest. So like once a year, you may want to put in at 2,500 to max out your grant. So you just take 2,500, you buy that single asset allocation ETF, and then the grant comes in and you use that to buy the exact same thing with the grant money, and then you're done for the year. So very, very simple, and it lets you manage, it makes managing the RESP very, very easy. Whereas, when you're buying individual ETFs, there's a lot more work involved. And I find that extra sort of work it can be good for retirement accounts because there's certain tax strategies that you can utilize. And that's what I do in my retirement accounts myself. But in the RESP, it's just not worth it. So asset allocations are the way to go, at least for me personally. And I have yet to interview a single person on the podcast that's a professional in this field is like strongly against asset allocation ETFs in the RESP. They're just such a good fit. They're good for the retirement accounts too, don't get me wrong. But for the RESP, they're like I would say a no-brainer, at least for me.
I totally agree, Kornel. Asset allocations really make so much sense for RESP accounts. Firstly, because they simplify the entire trading experience. So within one single trade, you get a fund of ETFs. You get 6 or 7 different ETFs within the one asset allocation ETF. You really only have to make, like you said, Kornel, one trade a year. If you do have an account that has commissions, this keeps your commission costs really low. And you don't need to be thinking about trading in and out of stocks or even trading in and out of individual ETFs, holding several. It just simplifies it all and streamlines the process. Again, you mentioned that really low management fee. We always like looking for low management fees on funds, because at the end of the day, that fee does erode returns. So something with a really low fee is also makes a great fit for an account like an RESP. For those investors out there who might not know what an ETF is, I will just briefly give you a quick understanding of them. An ETF is a fund. It's an exchange traded fund, very much like a mutual fund. So it is a fund of stocks or bonds, and it trades on the exchange. So when you go into your discount brokerage account, you can purchase stocks or ETFs or mutual funds for your RESP. Kornel and I were very passionate about ETFs. This is our vehicle of choice for where we want to put in our investment. And simply because, Kornel, you said it best, diversification, you're invested in thousands of stocks all around the world. So you're basically invested in the broad market, as we say, or bonds if you so choose to get bonds in your portfolio as well. That low cost fee and that efficiency, that ability just to click on the ETF ticker and buy it for your RESP. And then you don't have to look at that account again for an entire year until you fund it the next year. Just really simplifies that process. So Kornel, so we're going through the process. Now we've decided this is what we're going to invest in. We might choose to use an ETF. Maybe someone like me, I think I'd like to go in all equities because I know I have 18 years for my daughter before she graduates. So I'm going to take the all equity. I'm comfortable with that risk in the equity market. But now let's fast forward. What if we're getting now we're managing an RESP account. That account's been growing for 10, 15 years. How do we start to look at the account or manage that account as we start to approach the end of that time horizon for the account, or approach the moment when the beneficiary or that child might start to need to make withdrawals to fund education expenses?
Mm-hmm. Yeah, so for this one, I would say there's different options out there, different answers. There isn't some one golden answer that is going to be perfect for every single person in every single scenario. And the reason for that is one, because the risk tolerance of people does vary. And so what one person feels comfortable doing, another one might totally not, and it's going to, and worry if their kids are going to have enough for education, that kind of a thing. And like you mentioned, Danielle, the other big factor is the age of your children. So yeah, the typical strategy is that you have as much as you feel comfortable in equities when they are younger, because the markets have a lot more time to recover if there is a sudden crash. Whereas if your kid is starting post-secondary next year, and we had another COVID thing, there's like a 30% drop in the markets, and you were all equities, well, now you're kind of panicking because you've got that bill coming up for the post-secondary, and you're like, well, are the markets going to recover in less than a year? Hopefully, but maybe not, right? And so it can add a lot of extra stress from that scenario. So like I said, there are a few options that you can do. So I'll go through the pros and their cons. One is if, let's say, you're going with a high equity allocation. So like I said, let's say you have ZEQT, which is the all equity, right? So you're going to have the highest expected return, but you're also likely to have the most volatility because that's 100% equities. And so if, let's say, you don't want to get conservative, you're really trying to squeeze as much growth as you can out of your RESP, you don't want to switch to something more conservative because typically that means you're going to be having less returns, then you might have to ask yourself, okay, well, do I have enough month-to-month cash flow to not use the RESP if the markets take a dive right before the child starts post-secondary, right? An option is, let's say you have ZEQT, the kid's about to start school, and then the market crashes. Okay, well, what you could do then is you could just pay for the post-secondary out of pocket if you have that kind of cash flow available while you wait for the markets to recover. And then once they recover, then you start selling off some of your ZEQT, let's say, and use that to fund the education. So it's sort of like you're almost like self-insuring yourself in a way, right, by having that extra cash flow. So if you've got like a high income job, lots of savings, that kind of a thing, that could be something that is that is an option for you. Most dips in the stock market do recover within 2 years, but not always, right? So there is that risk that if you decide to stay all equity the entire time, you could say, okay, well, historically, it's probably going to recover within 2 years. My child's in university, let's say, for 4 years, so we should be okay. Perhaps, right? But no guarantees, right? There's no guarantees that for sure they're going to recover in 2 years. And so that's like I said, that's where it comes into that whole kind of risk tolerance thing. Are you willing to risk it? Do you feel comfortable risking, or are you going to be stressed because 6 months before your kid starts, the markets had a dip, or we had a 2008 scenario? So that's kind of the aggressive option. The other, I would say, less aggressive option that we have, or one less aggressive option, is you could remain in all equity with something like ZEQT, for example, but you could also start using something that's more, it's not volatile at all. So something like doing a GIC ladder for 2 to 4 years before your child starts post-secondary. And so that way, that money is guaranteed to be there for those years. So that way you're still in the equities, which has the higher expected return, but you can time it in a way where you take these GICs out, that you know that even if you have a 2008 type scenario or right before your kid starts, yeah, you're not happy about it, but you have that GIC that's maturing right before, and then you can now use that cash to pay for the kids' expenses. And so you know, depending on the time frame, you might take a longer one out if you're, you know, kind of feeling nervous and you want that extra security, or you do like a 2-year one. So again, it's kind of situation person, but you are allowed to have things like GICs in your RESP as well. And so that's one option if you're looking for something where, okay, I've got this chunk of cash, it's going to be available for sure, I don't have to worry, and I'm going to let the rest of it ride with the market. So that's another option. Or the option number 3, you move to some of your funds to lower volatility ETFs that contain more bonds. So for example, moving from ZEQT, which like I said is all equity, to something like ZBAL, which is 60% stocks, 40% bonds. So because there's that higher bond component in that ETF, you're likely to see a lot less volatility. It's got a bit of return, sure, but at that point, because your kid is getting so close to actually needing that money, you know, you are just shifting to a bit more of a conservative portfolio. And then within that, there's different options. Like some people might say, okay, I kind of want to sell all my, you know, I want to convert all of it to ZBAL, right? Or maybe they just want to take a portion of it, and that's the portion that's they're going to need in the very near future. So like I said, different options, not one, you know, silver bullet solution, but again, it really depends on how you feel about the markets. Are you going to be able to sleep at night? How secure do you want that money that you're going to need in a very, very short term? And then try to make a best decision based on that.
Perfect. Thanks, Kornel. So just to summarize, as we kind of move through that time horizon and we get closer and closer to wanting to, or to needing those funds, we kind of think about maybe taking some risk off the table, thinking about rolling out of equities, rolling into bonds or fixed income. Again, asset allocation ETFs make this very, very easy because you have your selection of an all equity asset allocation ETF, and then you can start moving down the risk spectrum as you can add a little more bonds to the portfolio into like a grow, like a Z grow or a Z BAL. So taking risk off the table as we get closer to the end of that time horizon, and then right before needing that money, thinking about a cash instrument like a GIC or a money market ETF. Money market ETFs, something like a ZMMK, are yielding almost about 5% right now. So if you are someone with an RESP account and your child is getting really close to graduating and needing that money for post-secondary, you're sitting in a really good rate environment to be in cash right now, because you can still get, you know, close to 5% on that cash investment. So lots of great things to think about. Kornel, thanks for joining us to break this all down. It was a really great discussion.
Awesome. Thanks for having me back, Danielle. That was fun.
Thanks, Kornel. And actually, Kornel is going to be back with us in a couple weeks' time. So next week, as a reminder, we are taking our Friday off because it's a long weekend. But we are going to hit you back with 2 amazing weeks of content starting on October 13th. It is our Fall into ETFs event. This is a 2-week event. Make sure you tune into that. I'm getting out of my home office and we will be in studio with Kornel and a few other great influencers and great speakers in the space. And we have a lot of great topics for you all to check out. So we will see you October 13th. And if you want to see more information on those sessions, etfmarketinsights.com. Take care.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.